Take a moment to look at this chart for me. This company went public exactly 5 years ago in April of 2021. It raised $1.34 billion, making it one of the largest US software IPOs in history. 1 month later, it went on to reach an all-time high market cap of $48.43 billion, giving IPO investors a return of 35% in just 1 month. But then, this happened. In February of 2026, that same company reached an all-time low market cap of $5.21 billion. That is an 89.24% collapse. 5 years of business and $43.22 billion in market value gone. Now, if I told you that this same company just posted its first full year of GAAP profitability in its entire history, and that it is sitting on $1.7 billion in cash with zero debt on the balance sheet, that it is generating almost $400 million a year in free cash flow, and that the market is pricing it as if the business is going to zero. You'd probably think I'm making something up there, but I'm not. So in this episode of the Liam Highland Portfolio, we are going to analyze this company, one where there are 6 different things scaring investors all at the same time, and figure out whether that fear is actually justified or whether the math is telling us something completely different. The company is UiPath. By the end of this video, we will have a complete framework with the exact figures and catalysts to watch, as well as a specific price target. But more importantly, we will understand why a stock can fall 89% and still be a potential buy. Because this pattern, and it is a pattern, is how real money gets made. Let's start. So first, for those of you who haven't heard of UiPath, what does this company actually do? UiPath makes software robots, not the kind with arms and legs, the kind that live inside a computer and do the tedious, repetitive work that humans hate. Think about every time someone in an office copies data from one spreadsheet, pastes it into another system, clicks 3 buttons, fills out a form, and does that 800 times a day. UiPath builds a software that does all of that automatically. It is called Robotic Process Automation, or RPA, and for a while, UiPath was the undisputed king of it. Gartner, which is one of the most respected analyst firms in enterprise tech, ranked them number 1 for execution for 7 consecutive years. They had 30% global market share, they were growing revenue 24% a year, and then in the space of about 18 months, everything seemed to break at once.
It's been an ugly start to the year for software stocks. Feels like we're in this kind of existential crisis. And the question that's increasingly being asked is, why does anyone need a software provider when their own engineers can spin up their own tools using something like Claude Code?
The stock went from 80 to 30 to 20 to 11. And the consensus on Wall Street right now is basically AI is going to eat this company alive. Why would anyone pay for clunky software robots when a large language model can just look at your screen and do it for you? That is the bear case. And I want to be honest with you, it is not a stupid argument. The argument goes like this. Large language models, ChatGPT, Claude, Gemini, are getting incredibly good at seeing a computer screen and taking actions on it. If an AI agent can just look at your browser, read what is there, click the right buttons, and fill in the right fields, what do you need a separate RPA tool for? And the market takes this seriously. When Anthropic, the creators behind Claude, acquired a startup called Vercept back in February to improve its computer use capabilities, UiPath stock dropped 3.6% in a single day. Every time any AI company announces anything about agents, UiPath sells off. But is the bear case seeing the full picture? Or is it missing something? Enterprise automation is not a consumer chatbot. A bank processing 10 million transactions a day cannot tolerate an AI that is 98% correct of the time. That 2% error rate on financial transactions in a regulated industry with compliance officers and auditors watching, that is a catastrophe. What enterprises need is not intelligence alone. They need governance, auditability, error handling, compliance logging, orchestration across dozens of legacy systems that were built in the 90s and have no APIs. And that is exactly what UiPath provides, the execution layer, the governed infrastructure that sits between the AI brain and the actual enterprise systems. Their new product, Maestro, coordinates swarms of AI agents alongside traditional bots with full audit trails. Think of it as air traffic control for AI. But now let me show you something counterintuitive, because the relationship between Claude and UiPath is not what most people think it is. If you spend time building projects with Claude Code, the AI coding agent, you can see what is actually happening in practice. Claude Code does not replace other software. It signs you up for other software. It creates Stripe subscriptions. It creates Vercel deployments. It sets up GitHub repos and database services. Instead of Claude eating all of that software, it actually creates revenue those companies never would have had. The AI agent becomes a new customer acquisition channel for existing software. Now, Daniel Dines, UiPath's founder and CEO, is saying that UiPath is rebuilding its entire platform to be coding agent first, not human first. Coding agent first. So when someone tells Claude Code, build me a governed auditable automation that works at enterprise scale, Claude Code can build it on UiPath, the same way it builds payments on Stripe. UiPath becomes a tool that AI uses, not a company the AI replaces. And if they execute on this, time to deployment drops from weeks or months to hours. Think about what that does for deal flow. Think about what that means for total addressable market. So fear number one, yes, AI is a real threat to simple, ungoverned automation. But the market is treating Claude and UiPath as competitors when they are actually partners. Anthropic makes more money every time Maestro calls a Claude agent. UiPath makes more money every time Claude Code builds an automation on their platform. This is not zero sum. Does that moat hold forever? I genuinely do not know, but I'll show you later why it does not need to hold forever for this investment to work. Fear number two is Microsoft's bundling. Microsoft has its own automation tool, Power Automate, and it comes basically free with your Microsoft 365 subscription. For a lot of companies that already live inside Outlook, Teams, SharePoint, and Excel, Power Automate is good enough. And that is the real competitive pressure. Microsoft has grown its RPA market share to somewhere between 8 and 12%, and it is climbing. But it's important to remember that Power Automate is excellent inside the Microsoft ecosystem. Where it struggles is with the ugly stuff, the legacy mainframes, the Citrix environments, the ancient SAP systems that were built before most of you were born. And that is precisely where most of the painful, expensive automation gaps live in these large enterprises. UiPath's screenplay technology uses computer vision to interact with any application on any platform, regardless of whether it has an API. Microsoft does not do that as well. Not yet, at least. By the way, keep this in mind when you're reading the headline saying AI is eating software for breakfast. Remember, these large enterprises have strict procurement processes to follow, right? Employees need to follow these to use software on their work laptops and phones. If an employee tries to install Claude on their work computer, it will get blocked, banned. These companies only allowed procured services like Microsoft Copilot because it has been formally approved by IT. That is the reality of enterprise software adoption. It is not Twitter. It is not a developer's side project. It is a Fortune 500 company that will not touch a tool until legal, compliance, and IT have all signed it off. And that process takes quarters, not days. So fear number two, it's real, but probably overstated. Let's keep moving. Fear number three is slowing growth. This one is undeniable. Growth is decelerating. ARR growth has gone from 22% 2 years ago to 11% last year. The net retention rate, which measures whether existing customers are spending more or less over time, has dropped from 108% to 107%. And the guidance UiPath gave for this year implies only 9 to 10% revenue growth. That is just not exciting. I'm not going to pretend that it is. But there are two things to keep in mind here. First, they are in the middle of a pricing model transition. They're moving from per bot licensing to a consumption-based AI units model. Those transitions always create temporary headwinds because the deal structure changes. And secondly, the company has gone through absolute leadership chaos. Daniel Dines, the founder, he left. A new CEO came in who was from SAP, and he left. The founder had to come back. That kind of disruption takes time to stabilize. We are still in the early innings of the Founders 2.0 era. So growth is slowing. The question is whether it is slowing towards zero or slowing towards a stable, profitable, cash-generative mid-single-digit grower. That distinction matters enormously for the valuation. Fear number four is the stock-based compensation. UiPath reported $370 million of non-GAAP operating income last year. Sounds great, right? But their GAAP operating income was only $57 million. Where did the $330 million go? Stock-based compensation. They are paying employees in shares, and that dilutes existing shareholders. 18% of revenue going to share-based compensation alone is high. But the trajectory is improving. SBC is declining as a percent of revenue, and the company has already bought back over $1 billion of stock, with another $500 million authorized. The buybacks are more than enough to offset that dilution. So while SBC is a legitimate concern for investors, it is one that is getting better in the right direction, not worse. And fear number 5 is the WorkFusion acquisition. In February 2026, UiPath acquired a company called WorkFusion that specializes in financial crime compliance, anti-money laundering, KYC, and fraud detection. It is a bet that UiPath can move from generic process automation into high-value vertical AI solutions for regulated industries. Now, this could be a brilliant move, or it could be a distraction. Integration risk is very real. Banks are conservative buyers, and the acquisition price has not been fully disclosed, which, to be honest, makes even me a little nervous. But the addressable market in crime compliance is enormous. Banks spend billions on this every year, and most of that spend goes to manual labor. That is exactly the kind of work automation is built for. And then fear number 6 is just the general macro environment. Enterprise IT budgets are under pressure at the moment. Sales cycles are getting longer. Chief investment officers are being asked to fund AI initiatives, and they have to cut spending elsewhere. And sometimes RPA is what gets cut, even though it should be one of the last things to get cut, because the whole point is to save money. So that fear exists, but it is cyclical, it is not structural, but it is real right now. Okay, so I just gave us a lot there. 6 different things scaring investors all at once, and I want you to understand I am not dismissing any of these. These are all real concerns. This is genuinely a scary time to look at this stock. But before we get into the framework, I want to reframe something, because I think a lot of the market is getting the competitive picture completely backwards here. Yes, every software company is now launching AI agents. Salesforce has Agentforce. ServiceNow has agents. Monday.com just said they are pivoting their entire company strategy from managing work to doing the work. And people look at all of that and say, more competition for UiPath. But think about what is actually happening. Salesforce is building agents that automate Salesforce. ServiceNow is building agents that automate ServiceNow. Monday is building agents that automate Monday. None of them are building agents that work across all of these platforms together. Now, a real enterprise workflow does not live inside one application. It starts in the ERP system, it touches CRM, it hits the compliance database, routes through the payment processor, and lands in the reporting tool. Who orchestrates all of those platform-specific agents into one end-to-end workflow? That is what Maestro does. So every new agent that launches on every new platform is not a new UiPath competitor. It is a new thing that needs to be orchestrated. Now let's actually build the framework. Let us strip everything away and just ask, how does UiPath make money? Now it really comes down to 4 variables. Number 1 are customers. How many enterprises are paying for the platform? Number 2 is adoption. How deeply are those customers deploying automation? Are they using it in one department, or are they using it across the organization? This is measured by something called the dollar-based net retention rate. Number 3 is platform breadth. Can they sell more products to each customer? Not just the basic bots, but process mining, document understanding, AI-powered testing, agent orchestration. And then number 4 is pricing power. Can they hold or increase prices as they layer AI capabilities onto their platform? These 4 things are what drive ARR, or annualized recurring revenue, which is the single most important number for this business. So the customer question is, are enterprises leaving UiPath? The data says no. Customers count is stable to growing. Their gross retention rate is 97%, meaning for every dollar of existing revenue, 97 cents renews the next year before any expansion. There is no mass exodus. Companies are not ripping out UiPath and replacing it with ChatGPT. This is just not happening. And there is also a detail worth noting in the fourth quarter. UiPath added the most new customers above $1 million in annual recurring revenue that they have added in a single quarter in 2 years. That does not support the thesis of a dying business. And then there is adoption, which is actually weaker. Net retention rate at 107% means customers are only spending 7% more year over year. That is down from 18% just 2 years ago. But it is still positive. So all it means is that customers are not shrinking, they are just expanding more slowly. And there is also an important leading indicator here. 91% of UiPath's customers with over $1 million in ARR have now started using at least one of UiPath's AI products. 91%. They have reached virtually all of their large customers. The adoption is happening. It is just not fully converted to revenue yet. Then there's platform breadth. This is where UiPath is genuinely ahead. They have process mining, document understanding, automated testing, orchestration for AI agents from multiple providers, OpenAI, Anthropic, Google, NVIDIA. And they have Screenplay, which uses computer vision so the AI agents can actually interact with applications, even those ones with no API. They are also building pre-built vertical solutions, right? These are turnkey orchestrations for specific industries like insurance claims handling and healthcare workflows that reduce deployment time by 70% or more. And they just partnered with Deloitte to build Agentic ERP solutions on Maestro, which gives them a massive distribution channel into exactly the kind of large enterprises they are targeting. And then lastly, there is pricing, which is also the trickiest one and one where I need to spend some time talking about cost. There's something I'm not seeing investors talk about online, and that is around the cost reality for deploying AI in enterprises. Running a frontier AI agent like OpenClaw continuously, having it think through every task from scratch, burn tokens on decisions it has made 1,000 times before, costs over hundreds of thousands of dollars a year, way more than the human it was supposed to replace. Now, the most intelligent AI systems are the most expensive per token. Every second of thought costs money. So just like you would not pay a PhD salary to have them do filing and data entry, you're not going to route every repetitive task through the most expensive model available. You're going to want the cheapest intelligence that can reliably do each job. And for thousands of repetitive deterministic enterprise processes, the cheapest tool is still RPA. Not because RPA is smarter, because it is cheaper and perfectly reliable for tasks that never change. So what does an enterprise actually want? A system that assigns the right level of intelligence to each task. The frontier model for complex reasoning, a mid-tier model for moderate decisions, and RPA for the repetitive stuff. And what coordinates all of that? An orchestration layer. So on reflection, customers are stable with large account additions accelerating. Adoption is slowing but positive, with 91% of big customers already using AI products. Platform is expanding with new partnerships and vertical solutions. Then finally, pricing, which is protected by the economic reality that the smartest AI is the most expensive. It creates a natural tiering that orchestration must manage. None of these variables are at zero. None of them are collapsing. They are all under pressure, but they are all still positive. And that distinction between under pressure and broken is everything when it comes to the valuation. Now, I want to show you something because this pattern has happened before. And the last time it happened, the stock went up 5 times. In January of 2023, Meta was trading at $130 a share, down 75% from its highs. Everyone thought TikTok was going to kill them. Apple had strangled their data signal. They were burning cash on the metaverse. Revenue was actually contracting, and Mark Zuckerberg had lost his credibility. Sounds familiar? So there is a pattern here. Stock declines from highs, Meta down 75%, UiPath down 89%. Existential fear for Meta, TikTok is killing the social graph. UiPath, AI is killing RPA. Platform bundling threat, Meta, Apple strangling the data signal. UiPath, Microsoft bundling Power Automate. Revenue transition pain, Meta, feed to Reels cannibalization. UiPath, per bot to AI units. Management credibility crisis, Meta had the metaverse spending, year of efficiency pivot. UiPath, CEO departure, founder return. WorkFusion bet. Cash on the balance sheet, Meta, strong, UiPath, $1.7 billion with zero debt. And buyback signal, Meta was aggressive. UiPath completed $1 billion and authorized another $500 million. Now, I am in no way saying that UiPath is Meta. Meta is a far better business with far stronger network effects and far higher margins. I'm not making that claim. What I am saying is that the pattern is the same. 6 things going wrong all at once. Fear compounding on fear. The stock getting priced as if the business is dying. And underneath all of that noise, the core question being much simpler than people think. For Meta, the core question was, are people still using Instagram? And the answer was yes. For UiPath, the core question is, do enterprises still need governed, auditable automation of complex workflows? And right now, the answer is also yes. All right, let us actually run some numbers. Here is what we know. UiPath just reported fiscal year 2026. Their year ends in January. Revenue, $1.61 billion, up 13%. ARR, $1.85 billion. Non-GAAP operating income, $370 million. Free cash flow, $372 million. And cash on the balance sheet, $1.69 billion. Debt, zero. For 2027, they are guiding to about $1.75 billion in revenue and $425 million in adjusted free cash flow. Now, before we look at the cases, I want to show you something about this guidance because there is also a pattern here. Last year, UiPath guided for 6.7% revenue growth. They ultimately delivered 13%, nearly double their own guide. Now, Daniel Dines is not the kind of CEO who pretends things are fine when they are not. When he returned as CEO in mid-2024, he was very blunt. He said execution was bad. He said growth would continue decelerating. He did not spin it. So when the same person guides conservatively and then delivers nearly double, there is a pattern there, and he is historically a conservative guide. There is also an important fact not picked up by Wall Street because they don't have analysts covering the stock. During the Q4 earnings call, Dines said that in almost every customer conversation, enterprises are telling him their automation backlog is growing. The ROI is approved by the C-suite. The projects are funded. They just do not have the engineering talent or the time to build it all fast enough. Now, either that is true or it is not. If it is true, then there's a very easy prediction here. They are going to beat and raise guidance multiple quarters in a row. If it is not, that will become obvious very quickly when they miss the first quarter. Either way, we will know within the next 2 quarters. But the fact that nobody is talking about this, that it has been completely ignored because it does not fit the current fear narrative, that is the kind of information asymmetry that creates good opportunity. So let's continue with the math. The company has a market cap of about $6 billion, but they are sitting on $1.69 billion in cash with no debt. So the enterprise value, which is the business we're actually valuing here, is only about $4.3 billion. I don't want to glance over that. $4.3 billion. For a business generating $425 million in free cash flow this year. That is roughly a 10 times free cash flow multiple. The median software company growing 10 to 15% trades at 15 to 25 times free cash flow. UiPath is trading at 10. The market is pricing this business as if growth is going to zero and the company is in terminal decline. So let's go through each of the cases. For the bear case, revenue growth decelerates to 5% a year. Margins stay flat, no re-rating. Under these assumptions, UiPath is worth about $10 to $12 a share, roughly where it trades now. So the current price basically bakes in near permanent mediocrity. The bear case is already in the stock. For the base case, revenue grows 8 to 10%, below current guidance, but reasonable. Margins expand to 27%, still below management's 30% target. A 15 times free cash flow multiple, which is a discount to peers. Under these assumptions, by fiscal 2029, you get about $15 a share. That is roughly a 35 to 40% return from here. And then the bull case. Agentic AI adoption inflects. ARR growth re-accelerates to 15%. Margins hit the 30% target. Coding agents reduce time to value from months to hours, expanding the addressable market far beyond the current enterprise base. The market re-rates UiPath from a dying RPA company to an AI orchestration platform. Under those assumptions, we arrive at $20 to $24 a share. That is a double to triple return from here. Now, I want to be very clear about something. I'm not predicting the bull case. I do not know if agentic AI adoption will inflect. I do not know if the coding agent first strategy will work. What I do know is that the bear case is already priced in, and the base case gives me mid-30s% returns with assumptions that are frankly very conservative. It is assuming below guidance growth. It is assuming below target margins. It is assuming a continued discount to peer on the multiples. And it is ignoring the backlog commentary entirely. That is the margin of safety. You do not need anything heroic to happen here. You just need the business to not die. Okay, so hypothetically, how would we action this analysis? How would we actually follow it through? And this is where it gets fun, because let's run a hypothetical decision framework. Where to get in, what to monitor every quarter, how to know whether the thesis is working or breaking, and what to do in each scenario, including when to take profits, when to add, and when to get out. The current entry zone is $10 to $11.50. That is the current trading range, near the 52-week low of $9.38. Why this range? Because at this price, the math does not require optimism. At $11, you're paying roughly 10 times free cash flow for a business that is growing, generating almost $400 million in cash per year, sitting on $1.7 billion with zero debt. Even in the bear case, you are not taking catastrophic risk at this price. If the stock drops to an $8 to $9 range on a broad software sell-off, not a UiPath specific deterioration, that is potentially an opportunity to actually add. It wouldn't be a reason to sell. The distinction matters enormously. Price going down because the whole market is selling is very different from price going down because the business is breaking. So now that we have an entry zone, let's look at the three cases and what needs to be watched each quarter so we know which case we are in at any given point in time. Here's how we would know we are in the bear case. Signal 1 is they would miss Q1 guidance. UiPath guided for $395 to $400 million in revenue for Q1, which reports around June. Their gross retention is 97%. That guided number is essentially what they would hit with almost zero net new business. If they cannot clear that bar, something is structurally wrong. Dine said backlogs are growing. If that is not true, we find out here. And candidly, if they miss Q1 and lower expectations, I would significantly reduce the position regardless of the stock price, because it would mean the backlog commentary was not real. Signal 2 is net retention drops below 105%. At 107, customers are still expanding, albeit slowly. Below 105% means customers are actively shrinking their spend. That is not slow growth. That is a contraction from within the installed base. Completely different story. Signal 3 is that major enterprise customers publicly replaces UiPath with an AI native solution, not a startup experimenting. This would be a Fortune 500 company that was a 7-figure UiPath customer saying, "We've moved to Claude," or "We've built a Nemo claw." One credible reference customer leaving the AI native alternative breaks the moat thesis. Signal 4 is that discretionary insider selling accelerates, not the routine RSU tax withholdings, those are mechanical. The CEO or CFO making voluntary open market sales at these depressed prices. That would mean the people who know the business best do not believe in the recovery story. Signal 5 would be Nemo Claw or an equivalent gaining real enterprise traction. At GTC, NVIDIA devoted significant airtime to NemoClaw, their enterprise-grade open-source agentic framework with security, local compute, and agent permission controls. It is free. If NVIDIA pushes this the way it pushed CUDA at the very start, showing up in enterprise developer adoption metrics, that is a direct Maestro competitor at a price of 0. Okay, so if 2 or more of those signals are present in the same quarter, that is a clear signal to exit the position. With the entry range, a realistic stop loss would be around the $8.50 mark. If the stock breaks below that, the fundamentals confirm it, that is the exit signal. Accept the loss, about 24% from the entry midpoint, and move on. That gives a bear case price range of $6 to $8. You do not want to own it there. So then how do we know if we are in the base case? This is the most likely outcome. Signal 1, they beat Q1 guidance modestly, say 400 to 420 million in revenue. It's not a blowout, it's just a clean beat that confirms execution is at or slightly above plan. Given the sandbagging pattern, even a modest beat is meaningful. Signal 2 would be the net retention stabilizing between 105 and 110%. It stops declining, it does not need to spike, it just needs to stop getting worse. Signal 3, ARR growth holds between 10 and 13%, consistent with the current trajectory. No acceleration, no deceleration. Signal 4 is that operating margins expand towards the 25% non-GAAP point. They guided for around 24% this year. If they deliver on that and signal further expansion towards the 30% target, the profit story is intact. And Signal 5, buyback execution is steady. They are spending $200+ million a year buying back the stock at these prices. That provides real per-share acceleration even without revenue acceleration. In this case, UiPath grinds. Revenue growth is high single digits, margins expand, free cash flow grows to $500 million plus within 2 to 3 years, the share count shrinks through to the buybacks, EPS grows faster than revenue because of operating leverage plus the buybacks. The multiple gradually re-rates from 10 times free cash flow to 13 to 15 times as the market realizes the business is not dying. That would give a base case price range of $14 to $16 within a 12 to 18 month time frame, a 30 to 45% return. In terms of profit taking, if the stock reaches $15 and the data still looks like the base case is intact and not the bull case, that's an opportunity to trim a third or to half of the position. Holding beyond that requires the bull case, which carries different risk. So then to know we are in the bull case, signal 1, revenue beats guidance by more than 10%, similar to last year's pattern. If they guided 9% and deliver 14 or 15, the market immediately begins repricing the stock. This is exactly what happened with Meta and Palantir. Signal 2 is that net retention re-accelerates above 112%. Existing customers expanding meaningfully faster. It signals Maestro is converting from pilot stage to production revenue. Signal 3 is that net new ARR in a single quarter exceeds $60 million. Their best quarter in FY 2026 was $70 million, but that was the seasonally strong Q4. 60 plus in a non-Q4 quarter is a genuine acceleration. Signal 4 is that we have named enterprise wins for the coding agent first platform or the Deloitte Agentic ERP partnership. Not press releases, actual named customers on earning calls saying we deployed Maestro and here is what happened. This is the catalyst that changes the narrative from maybe to actual evidence that it is working. And then Signal 5 is where we have the self-service offering gaining traction. If the agent builder product, where non-engineers build automations through a chat interface, starts generating measurable new customer additions outside the current enterprise base, that is total addressable market expansion that nobody is pricing in at the moment. And so if the stock finds itself in the bull case, we've got revenue re-accelerating to the 15 to 20% growth, the market re-rating UiPath from a legacy RPA in decline to an AI orchestration platform, the multiple expands from 10 times free cash flow to 18 to 22 times. This is a Palantir type pattern. Years of sideways, then a violent re-rating when growth inflects. That would give a bull case price range of $20 to $24 within 18 to 24 months, a double to triple return from entry. In terms of taking profits, if the stock reaches $20 and is trading above 20 times free cash flow, that is an opportunity to start taking meaningful profits, maybe half the position, unless the data strongly supports sustained 20+% growth, in which case the multiple could expand further. But at 20 times free cash flow on a mid-teens grower, you no longer have a margin of safety. You are riding momentum, and the momentum works until it does not. So now that we know what to watch, we also need to know when we get the answers. This is not a trade where you buy and check back in 2 years. There are specific dates where data arrives and tells you which case we are in. Checkpoint 1 is the Q1 FY 2027 earnings, which is approximately in June 2026. This is the single most important data point. Revenue versus the 395 to 400 million guide. Net retention, net new ARR, and qualitative commentary on the backlog. A clean beat with stable NRR puts us firmly in the base lane with a shot at the bull lane. A miss changes everything. Checkpoint 2 is the launch of the coding agent first platform, which is expected in Q2 of 2026. Dine said on the earnings call that this is weeks away. If it ships and developers start building on UiPath meaningfully faster, that is a catalyst that could shift us from a base case to bull case, and that will be picked up in the commentary. Checkpoint number 3 is the Q2 FY 2027 earnings, approximately September 2026. But now we have 2 quarters of data, 2 consecutive beats with a stable or improving NRR. It is a very strong signal for the base to bull case. We'd also watch for buybacks and how much did they actually spend in the first half. Checkpoint number 4 would be the Q3 FY 2027 earnings, which is approximately December 2026. The coding agent first platform will have been live for 2 quarters. The Deloitte partnership will have had time to generate pipeline. If there's no measurable acceleration in net new ARR by this point, the bull case is off the table. You're now managing a base case position. And then finally, checkpoint number 5 is the FY 2028 guidance, which is expected approximately March 2027. This is the thesis endpoint. If UiPath guides for double-digit growth with expanding margins, the bull case is confirmed. If they guide for further deceleration, you have a stable but unexciting base case, and then you decide whether the remaining upside justifies the position. Now, if we just probability weight all 3 scenarios, the expected value of the setup is roughly positive 25 to 35%. It's not a guarantee, but it is asymmetric. And here is the key insight. You do not need a bull case to work. You just need the bear case not to happen. And the bear case requires very specific things to go wrong. Missed guidance, declining retention, competitive displacement. That we can all monitor in real time and react to. It's not hope, it's just simply a plan. Now, I just want to zoom out for a moment, because this video is not really just about UiPath. It is about a pattern we see in the market. And the pattern is this. When 6 things go wrong at once, the market panics. It sells first and asks questions later. And the stock price, which is supposed to reflect the fair value of the business, instead starts reflecting the intensity of the fear. And those are 2 very different things. The skill, and one I'm trying to develop in myself, is learning to separate the fear from the fundamentals. To look at a stock like this that is down 89% and not ask, why is everyone selling? But ask, what does the business actually have to do for me to make money? And in this case, where the answer to that question is just do not die, when you're buying at a price that requires the company to only survive and grow at mediocre levels, that is what margin of safety looks like. It certainly doesn't feel safe, and it never does. And that is the whole point. If it felt safe, the stock would not be at $11. And one more thing, there is a concept in investing called the innovator's dilemma, where a company that dominates its market refuses to adopt new technology because the old technology is still profitable, and then a cheaper, scrappier competitor eats them below. But UiPath is not doing that. They are not clinging to legacy RPA and pretending AI does not exist. They built Maestro. They are integrating every major LLM. They are making their platform coding agent first. They are hiring forward deployed engineers to reduce time to value. Whether all of that works is uncertain. But one thing is for sure, UiPath team are not asleep. Now, the purpose of this video was to cover a stock the market has declared an AI loser. It is not financial advice. I wanted to share the analysis here for educational and research purposes. To me, this is an interesting situation. Always do your own research before investing. And if you found this kind of analysis useful and interesting and you want me to do more deep dives like this, hit subscribe. I want to do more of these. The ugly charts, the scary headlines, and then the actual math underneath. I'll see you in the next one.